Topic 1. Geopolitical conflict in the Middle East. U.S. strikes on Iran, Houthis' maritime embargo, and warnings over regional escalation is driving market volatility. U.S. Treasury yields ticked up, oil prices reacted to both attacks and talk of negotiations, and airlines and carrier stocks, Ryanair, JetBlue, felt pressure from higher fuel costs and operational shifts. Detailed content, concise key points, focus on how Middle East geopolitical conflict affects finance, energy, and aviation markets. Escalation of military conflict. The United States carried out airstrikes against Iran for 9 consecutive days, hitting significant military and maritime facilities, and Iran has continued retaliatory attacks through its allies and linked forces in the region, for example, the Houthis and some regional states. U.S. military personnel suffered casualties, and the U.S. reactivated a naval blockade on Iranian ports. Houthi blockade threat. Yemen's Houthi rebels declared an immediate Saudi maritime blockade, blocking parts of the Red Sea and Gulf of Aden, and threatening choke points like Bab el-Mandeb and the Strait of Hormuz. This has put oil and shipping flows at risk. The number of transiting vessels dropped sharply, and some ships reported being struck or catching fire. Oil surge and energy market instability. Geopolitical uncertainty pushed oil prices sharply higher, Brent near the 90s and WTI in the 80s, while the U.S. national average gasoline price climbed back toward about $4 per gallon. China's adjustments to imports, refining, and exports added to global supply tightening. Bonds and yields reaction. Rising tensions produced modest increases in U.S. Treasury yields, 10-year around 4.576%, 2-year around 4.208%, 30-year around 5.09%, reflecting market repricing of inflation and interest rate uncertainty tied to geopolitical risk. Fed officials signaled the possibility of further rate hikes to curb inflation, raising the odds of higher rates at year-end. Risk assets and precious metals. Rising oil heightened inflation fears and market volatility, while the prospect of higher rates put pressure on non-yielding assets like gold, which saw mild downward adjustments. Aviation industry hit. Higher fuel costs and traveler caution pressured airline earnings and stock prices. Ryanair's first quarter net profit plunged 34% to €538 million, with average fares down about 6% and about 20% exposure to unhedged fuel. The broader industry, including low-cost carriers, warned of a difficult winter due to fuel expenses, route changes, and demand uncertainty. Short-term outlook. Geopolitical risk is likely to continue impacting oil prices, fares, bond markets, and corporate earnings, especially for airlines, shippers, and refiners, until tensions ease. Diplomatic signs or mediation, for example, Pakistan brokering talks, could temporarily calm markets, but sustained blockades or reprisals would risk deeper supply disruptions and stronger inflation and rate pressures. Four-line summary: the U.S.-Iran military exchanges and the Houthi maritime blockade risk have sharply raised energy and shipping supply fears, lifting oil prices and gasoline costs. Financial markets reacted with modestly higher Treasury yields and greater volatility as inflation and rate expectations were repriced. Airlines faced direct pain from rising fuel bills and route disruptions, weighing on profits and stocks. Unless diplomatic breakthroughs emerge, these geopolitical tensions will keep pressuring energy, transport, and financial markets. Topic 2. Gasoline prices have climbed back to about $4 per gallon after crude oil surged more than 15% in a single week. Detailed content, key points. The U.S. national average price for regular gasoline has risen again to around $4 per gallon, according to AAA, driven by crude oil jumping more than 15% in a single week. The spike was driven by the escalation of military clashes between the U.S. and Iran, which has reduced traffic through the Strait of Hormuz, combined with disruptions to refined fuel export